The 5 keys to the construction of the interest rate and how knowing it can make you as an investor more money. The interest rate that you pay as an investor has a lot of components to it, but understanding the backbone of where that comes from can really help you as an investor. So the first thing that you want to know is traditionally the 10-year Treasury bond has been the basis for what establishes the interest rate. And the reason for this is because investors, when they go to buy a bond, they can choose between a Treasury bond, a lot of other corporate bonds, or a mortgage-backed security. And a mortgage-backed security kind of creates a secondary market for mortgages after they're created in the market. And the demand or lack of demand creates upward or downward pressure on the interest rate charged to the investors or homeowners who have those mortgages. So with a mortgage-backed security, there's a spread between what the cost of a 10-year Treasury is and the interest rate. And that spread is 2 components. And the first component is basically the cost to create the mortgage-backed security. So whenever you have a lender, their cost to create that security and bundle it and put it out to the market. And there's also a secondary part of the spread, which is the risk. So an investor, when they go buy a bond, when they purchase a federal 10-year Treasury, they realize that the risk is very, very low, right? The federal government would have to default. However, with a mortgage-backed security, there's a little more risk because what if something happens to the real estate market like what happened in 2008? So the investor demands more of a return for to purchase a mortgage-backed security versus purchasing a 10-year Treasury. So that's the spread between those two, but they're very closely related. So that's why you can look at the 10-year Treasury, add in the spread, and you know what the interest rate in the market is going to be. So the second thing you need to know is that when people talk about the Fed lowering interest rates, they're not just going out there and magically compressing the interest rate. What the Fed is doing is setting the rate that is the overnight bank lending rate from bank to bank. So when that rate is lower, banks are more incentivized to go out and lend money. And when they're more incentivized to lend, it puts downward pressure on the interest rate as a result. So that is a direct relation, but not a measure for measure where the Fed can actually control the interest rate. The third thing you need to understand is that residential and commercial rates are different. And this can be a little confusing for people because it's not just like, hey, this is the interest rate and it is what it is. So in order to understand why that is, you need to understand the role of a GSE, which is a government-sponsored entity like Fannie Mae and Freddie Mac. The role of those entities is to create a more liquid market and to guarantee or ensure the risk that mortgage may be to the investor. So the GSEs establish a baseline for what they require in order to ensure that mortgage against the risk. And if it meets those baselines, it's covered. And that creates a lot more strength within the mortgage market. And this is traditionally residential loans, but the GSEs actually do multifamily loans as well, which typically start at like $1.5 million, but really start to have a pricing power that makes sense between $3 and $5 million. So with the Fannie and Freddie multifamily loans, those can actually be an interest rate that's lower than a residential rate. And the reason for that is because the cost to create that mortgage is lower because there's much more efficiency of scale. So imagine if you're doing a $10 million multifamily loan versus if you had to create 20 residential loans of $500,000 apiece in order to equal the same $10 million. So there's more efficiency of scale within the multifamily market, but it's backed within the same Fannie Mae or Freddie Mac guarantee in order to mitigate that risk. So if you're backed by those government-sponsored entities, the risk is lower, hence the interest rate is also lower as well. So if you go and get a commercial loan from a bank, that's typically going to be a fair amount higher than a GSE-backed mortgage. And the reason for that is because the banks traditionally keep those loans in-house, and they're measuring that increased cost and the risk that's associated with it. So usually banks are charging 100 basis points, which is a 1% interest rate, or more, sometimes a little less, depending on the factors in the market, for a commercial rate versus what a residential rate would typically look like. There's also commercial mortgage-backed securities, which is the commercial equivalent of the residential mortgage-backed security. These are commercial loans that are bundled and put out into the market. And those can typically have pretty competitive interest rates as well, lower than a residential rate, simply because there's a lot of efficiency of scale, because these are traditionally only for larger loans of $5 million plus. And because of that, there's more efficiency, that risk, that premium is lower, and you can usually get a rate that's pretty equivalent around the traditional residential interest rate. So the fourth thing that you should be aware of as an investor is that the 5-year Treasury rate right now is actually influencing rates just as much, just because we're in a time of a lot of volatility, concerns about tariffs, what the economy is doing overall has created a lot of volatility in the market. So a 5-year Treasury is also a really good metric to watch, just because of that volatility in the market. So anytime like now when you're seeing that, keep an eye on that as a metric as well to gauge what the interest rate is doing up or down in the market. And the fifth thing that you as an investor should be aware of is the fact that you can leverage this knowledge in your favor. So what do I mean by that? If you have a refinance coming up, understand that if interest rates are on the down, the banks and lenders are going to be more motivated to make a loan, and you can negotiate better terms, whether that's going to be a lower prepayment, a better interest rate, a higher LTV. You are more so in the driver's seat when you're in that position, so make sure you use that to your advantage if you're negotiating a new loan. Also, if you are using short-term debt for fixing up a property, a bridge loan, construction financing, if you're in a period when interest rates are going down, it's probably a great time to use floating rate debt, even though that might sound scarier. If you have the option between fixed and floating, look at the floating, because that could actually give you a lower interest cost because it will be floating down instead of up. And then also, if you are planning to sell or considering a sale in a time when interest rates are falling, know that you as an investor are going to get more money for your property. And that's simply because buyers are always more motivated to buy and can find better terms when that interest rate is going down in the market. So it's a great time to sell because you will have more competition and earn a better price. So I hope those 5 things related to interest rates really brought you some value. If so, please like, comment, and share. And if you're looking for investment real estate within Pennsylvania or Maryland, please reach out to us. We would love to work with you and help you get the most value for your investments.